Thank you for joining me. I'm Alex, and I would like to talk to you about Walt Disney. So, Walt Disney has cruises and parks, and they also make movies and stuff. Nowadays, they do a lot of stuff, and they do a lot of parks, and they still do cruises, and they also make a lot of movies, especially since like Marvel and Star Wars and a whole lot of stuff that tends to be very profitable. It tends to be good movies. People like to see them and everything. So, current price is $131 almost. Market cap $274 billion, which is definitely not a small company, and a PE of 17, which I was kind of surprised about. You would think a company like Disney, especially when they announced their own streaming service and had so many so successful movies recently, that their PE would be, a lot higher. So dividend yield 1.36% with a payout ratio of 23%, which is definitely not terrible. Obviously, under 2% dividend is not really great for dividend investors, but having a very secure and stable company that has a lot of room to grow, that is apparently making all the right decisions. And we're going to have to see where Disney Plus is going, because the competition is increasing a lot. But a very safe company with a very good business model, with a very good revenue, and still paying a dividend yield of 1.36% is definitely not terrible. So if you have that in your portfolio and you get some dividend, it's not terrible. Revenue $59 billion, earnings of $12.6 billion, which is pretty much the same earnings as a company like Walmart, which has almost 10 times the revenue and a market cap of I don't even know. It's not actually that much higher than this. So obviously earnings amazing. Obviously also plus 40% is not generally their growth rate. So take that with a grain of salt. Obviously that also influences the dividend yield and the payout ratio, but definitely going in the right direction, and it has been going in the right direction for many years. Total assets $99 billion, total liabilities $46 billion, and total stockholders' equity of $49 billion, which is up 15% from the previous year, which is amazing numbers. So obviously the tax cuts kind of played a part in that, and obviously the whole Marvel and Star Wars and everything also played a part in that. So to sum that all up, we don't know where Disney Plus is going, but Disney, with the 100-year history basically of making movies that people want to see, especially children, and TV shows, and obviously the parks are an attraction everywhere. So very safe business model, very much room to grow still. Which seems like a weird thing to say, but the cruises can grow, the parks can grow, the movies are growing amazingly, and the stuff is a lot of merchandise, TV shows, and a lot of other stuff where they have room to grow and could be doing great things. So to sum that all up, obviously growth investors might not want this company because the growth is a lot smaller than what you would expect from the new tech startup. A dividend investor might also want to look elsewhere for companies with a higher dividend yield. But for a value investor, we have a PE of currently under 20, even though I'm not sure if that will hold true in a couple of years, because we don't know how everything is going right now. We don't know if they can sustain the levels after the huge jump that they did in earnings. But overall, I would say that for a value investor, this seems like the company you want to invest in. PE of under 20 is pretty good. Dividend yield is something. Obviously, it's not great, but it's something. Revenue is going in the right direction. Earnings are going in the right direction. Stockholder equity is going in the right direction. They seem to be making the right moves. Their management seems to be doing amazingly. So to sum that all up, I think for a value investor, this is definitely a company you want to do your research for and probably invest in. And I would say that it's good to diversify from retail and tech and the kind of disrupting companies. I would say that Disney is very safe stock to invest in, so that you can diversify the risk out of your portfolio a little bit. So I will probably not be investing in Disney, but I'm definitely considering it. And if I had the need to diversify, I think I would buy the Disney company right now, because I think it makes sense. Definitely good stats, definitely good growth, definitely like the way it's going, definitely like pretty much everything about the stock right now. So if you like this video and you haven't already, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.